Hi, folks. Welcome back to Murthy Finance Academy. Today, we will discuss one small cap player which is becoming retail investors' favorite, which is nothing but Manorama Industries Limited. So, Manorama Industries has delivered an explosive 9 months fiscal year 2026, reporting revenue growth of 81.3%, EBITDA growth of 108.3%, and a PAT surge of 148.9% year on year. The company is aggressively expanding its fractionation capacity to 52,000 MTPA through debottlenecking, with the full incremental throughput coming online starting Q1 fiscal year 2027. The real question, can Manorama scale its capacity by 150,000 plus MTPA without diluting 25% plus EBITDA margins or over leveraging its balance sheet? So, Manorama Industries operates in a high barrier niche of the specialty fats market that management characterizes as structurally undersupplied. As global chocolate and confectionery giants face unprecedented cocoa price volatility, the strategic value of exotic fats, specifically cocoa butter equivalents, has transitioned from a cost saving luxury to a supply chain necessity. By processing wild harvested seeds like sal, mango, and shea, Manorama provides a technically functional alternative that is increasingly indispensable to global food majors. The company utilizes a unique forest to fork model, managing a complex procurement network that reaches deep into Indian and West African forests to serve the chocolate, confectionery, and cosmetic sectors. This is not a commodity crushing business, it is a technology driven play. The recent acquisition of 19.4 acres of land and the massive 90,000 MTPA backward integration project in Burkina Faso signal a strategic pivot. Manorama is no longer just a local processor, it is evolving into a global supply chain behemoth capable of dictating terms in the exotic fats niche. Manorama is an integrated specialty fats player specializing in the fractionation of exotic seeds into value added products like stearin, CBE, and cocoa butter alternatives. Unlike traditional oil processors, Manorama business model is built heavily on backward integration and proprietary R&D, currently scaling from a 40,000 MTPA base to a 52,000 MTPA capacity target. So the company's defensible moat is rooted in its logistical mastery over wild harvested seeds. Seeds like sal and mango are seasonal with a critical procurement window of just 20 days for the entire year. This creates a massive barrier to entry. A competitor cannot simply buy their way into this market without a decades old sourcing network. Furthermore, Manorama's move into ESOS, enzymatic stearin olic stearic processes, utilizes enzymatic intensification, a high-tech, high-barrier technology that offers significantly higher yields and functional precision than standard chemical processes. This technological edge transforms them from a seed crusher into a specialty chemical entity. The Manorama's thesis is a volume mix compounding story. Moving from a 52,000 MTPA base to adding 150,000 plus MTPA of new capacity represents a structural shift in the company's revenue ceiling. The calculus relies on three pillars: aggressive volume expansion, an interesting value added product mix targeting 90% plus, and margin stability via a cost plus margin model. The market frequently fails to grasp the decoupling from cocoa prices. Manorama does not process cocoa beans, it processes exotic seeds. When cocoa prices skyrocket, chocolate manufacturers increase their CBE usage to maintain price points. Because Manorama operates on a cost plus basis, they are beneficiaries of high cocoa prices, which is a demand tailwind, without being victim of the beans price volatility. On the industrial scale side, the expansion is not limited to India. The company is already targeting 2,000 plus tons from its Mexico facility, providing the model is geographically agnostic. So the global CBE, cocoa butter equivalent market, is currently in a sweet spot of structural undersupply. Food majors are racing to reformulate products, mitigate cocoa bean inflation. Yet very few processors possess the enzymatic technology or the wild harvested raw material access required to produce high quality CBE at scale. Strategic regulatory tailwinds are also at play. While the EU deforestation regulation is looming threat for palm and farm-grown crops, Manorama is uniquely insulated. Management has clarified that because their seeds are forest collected rather than growing on cleared agricultural land, they are naturally compliant with deforestation mandates. This positions Manorama as a safe haven supplier for European food giants. In a competitive landscape dominated by low margin commodity players, Manorama's technology driven formulation specific approach protects its niche. So the company's value-added products currently 75% of sales mix with an intent to push this toward 90 to 95% as new lines come online. The CBE contribution, a high margin core representing 30% of total revenue, and its asset turnover, which is targeted at more than 5 times for the new forward integration projects for CBA and ECSOS. And capacity utilization is also sustained at 85%. Its debottlenecking provides the immediate bridge to fiscal year 2027 growth. Its raw material strategy is also cost plus margin pricing protects EBITDA from commodity swings. And its enzymatic edge, the new ESOS process is expected to deliver superior yields over traditional fractionation. And its working capital nuance also, its 120-day cycle is a result of the 20-day annual procurement window for seasonal forest seeds. So the financial performance for 9 months fiscal year 2026 highlights a company in high growth mode, but a deep dive is required to understand the quality of earnings. The working capital cycle lengthened from 90 days in H1 to 120 days, a deliberate move to lock in inventory during the peak procurement season. So the company's revenue, Q3 revenue grew 73.3% year on year, with 90% of this growth being volume driven. This confirms that growth is not just a function of pricing tailwinds, but a result of real market share gains. And Q3 gross margins contracted to 44.3%. Previously, it is 52.8% due to higher freight costs and byproduct realization fluctuations. However, EBITDA margins expanded to 27.1%, which is up from 16 to 17% historically due to massive operational leverage and a better product mix. 25 to 25%, 25 to 27% is the new sustainable corridor. The 460 crore capex plan is remarkably being funded through internal accruals. This signals high cash flow generation and a management loath to dilute equity. Coming to its earnings trajectory, the revenue guidance for fiscal 2026 has been revised upward from 1,150 crores to 1,300 crores, reflecting strong demand visibility. So Manorama's 148.9% PAT growth is impressive, but investors should note two: quality of earnings adjustments and a reversal of ESOP provisions, which lowered employee costs, and a jump in other income driven by forex gains on imports. Strip those away, and the core EBITDA growth remains robust, proving the volume and margin thesis is working. So coming to its con call highlights, the company's backward integrated models creating a defensible competitive mode. So here the forest sourcing network is the primary barrier to entry that prevents commoditization. The company is using more technology and formulation driven business, but it is not a commodity business. So it shows that the focus is on enzymatic intensification barrier, not just seed crushing. And its forex gain on the import side, difference of what we have paid and what we have booked is high. Other income in Q3 was largely a non-core inventory forex benefit that won't necessarily repeat. And management is also walking the talk on self-funded growth, reducing the risk of equity dilution. And management also acknowledges the inherent execution risks in simultaneous global expansions also. And they aren't looking for customers. The customers are waiting for the capacity. So which is a huge advantage for the company. So the company is also having a Brazil JV with Decal. It's a strategic beachhead into the world's largest confectionery market, which can tap the Latin American market. So management has raised fiscal 2026 revenue guidance from 1150 to 1300 crores mid-year, while outperforming the 5 times asset turn target for incremental capex is exceptionally aggressive for an industrial business. If the 120-day working capital cycle stretches as the scale to 2 lakh plus MTPA, the internal accrual funding strategy will be tested. So here management is promising a 5 times asset turn on new projects. In simple terms, for every 1 rupee they spend on a factory, they expect 5 rupees in sales. This is rare in manufacturing. If they achieve even 4x, the revenue growth will be legendary, but the execution risk is high. Company's current fractionation capacity is at around 40,000 MTPA, which is going to raise to 50,000 MTPA by Q1 fiscal year 2027. And its revenue guidance are also improved to 1,300 crores. And asset turnover target is also improved to 5 times for forward integration projects. So, which we need to watch care closely. And its working capital is also steady at 120 days. So, seasonal hump, which needs to be monitored. And its value added mix, which is now around standing at 75%, but they are targeting to 90% plus. So when value added mix increases in the total revenue, then margins also will tend to increase. So the company is a traditional multiples often look expensive because it is during a massive capex cycle where a denominator, its current earnings doesn't reflect the future capacity coming online. So in a bull case scenario, if successful commissioning of 150K MTPA capacity by fiscal year 2028 at a 5 times asset turn and 27 margins, Manorama scales into a multi-thousand crore revenue powerhouse with dominant global market share and self-funded growth. In a base case scenario, if it hits 1,300 crore revenue in fiscal year 2026, new projects come online but achieve a more conservative 3.5 to 4 times asset turn, margin stabilize at 25% despite freight volatility. In a bear case scenario, if execution delays at the Burkina Faso plant due to geopolitical instability, working capital stretches beyond 150 days, forcing the company to take on heavy debt, compressing ROE, and delaying the capex to revenue conversion. So the stock is growing revenue at 81%. On paper, it looks expensive. But if you believe the structural shortage story, you are buying a company about to quintuple its capacity into a market that is begging for its product. So key risks which we can see in this company are execution risk. Simultaneous expansion in India, Burkina Faso, and Brazil is a monumental project management challenge. Second, raw material concentration. The business relies on wild harvest. A single bad monsoon or forest fire season could, during the 20-day procurement window, could cripple a year worth of raw material. And third, geopolitical risk. Burkina Faso is a complex jurisdiction for a critical 90,000 MTPA backward integration plan. The last one is working capital stress. While currently at 120 days, if procurement costs rise or the cycle extends during the 150 MTPA scale up, the internal accrual strategy may break. So, what are the some key monitorables we need to watch out for our Q1 fiscal year 2027? Whether completion and commissioning of the 12,000 MTPA debottlenecking, Burkina Faso progress on equipment ordering and site preparation for the 90,000 MTPA plant, and Brazil's decal JV quarterly volume updates as batches ramp up in LATAM, and Mexico plant achieving the 2,000 tons volume target for the current year, and margin stability, maintenance of the 25 to 27% EBITDA corridor despite gross margin fluctuations. And sixth, inventory levels, ensuring the jump to 120 days working capital remains seasonal and doesn't indicate a permanent inventory drag. And the last is enzymatic line, successful conversion of olein, soft fats into stearin via the new ESOS line. So the bull case for Manorama is pure volume and margin expansion story. The company is a niche leader, finally gaining the industrial scale to dominate global market that is structurally short on specialty fats. With a cost plus margin model that provides a natural hedge against cocoa volatility, a deep sourcing moat, and capacity headroom funded by internal cash, the company is well positioned for the next leg of growth. Watch for the Q1 fiscal 2027 capacity completion and the Burkina Faso equipment orders as the defensive milestones. The market is slowly waking up to the growth, but it likely still underestimates the sheer magnitude of the 150,000 MTPA expansion relative to the current base. Hope you like this video. If you do like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.